Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. It's our market update. We've got big news on house prices, stamp duty being removed, and will we see a 99% loan-to-value mortgage? All that and so much more in this week's pod.
Welcome to the Property Podcast. Thank you for joining us. If you don't already know, we founded a company called Property Hub, which did over £100 million worth of property deals last year. And this is the show where we bring you some of what we've learned along the way for free. We also have a column in the Sunday Times, and this week we're helping a landlord who's had probably one of the worst things you can possibly have as a landlord happen to them, which is that who they thought were their tenants are not their tenants. Their property's been illegally sublet to people they don't know, and they don't know what to do about it. So we are helping them out. You can find that if you pick up the Sunday Times this weekend. But right now, we've got loads of news to cover. It's time for our market update, and it's been quite the start to the year. 2024 is still young, but there's loads going on in the world of politics, which we'll be covering shortly. Plenty to say about house prices as well, because there are some surprises there. But we should start up with interest rates, which are actually the least interesting item this week because nothing's changed. Bank of England had their meeting last week, decided to keep rates as they are. But the path of rates, so important, obviously, for mortgages and the housing market at the moment. Everyone's been analysing what the individual members of the committee were doing and how many people were voting for this and how many for that, trying to get some clues about what's to come, because it's such an important factor. But so far, no drama, no change.
But sometimes the expected happening is good news for mortgages, so we'll cover that shortly. But before we do, let's talk about house prices. Because we've had some data out from Nationwide. The Halifax data comes out just before we release this podcast, so we don't have that yet. But Nationwide have seen house prices go up in January by 0.7%. So 0.7%. As a reminder, Halifax last year had property prices up slightly, and Nationwide had property prices in the UK down slightly. But a strong start from Nationwide. And Rob, there isn't actually that much data in the press release from Nationwide. It doesn't talk about the areas and how this number is made up. But what we do know from Halifax is that its numbers were driven up by different regions away from the southeast. So Scotland, Northern Ireland, Yorkshire, really leading the way for house prices and pushing them up in an upwards direction, and it being dragged down by London and the southeast. And although we don't have that data here for Nationwide, anecdotally at least, where I live in the southeast of England, I can see the market struggling here. Prices are softening in my area. And I know people listen to this if they live in London or the southeast, and they're hearing that property prices have gone up by nearly 1% in 1 month. What is going on? Well, it is all going on, but just not in your area. For those who live in the Norths or Scotland or Northern Ireland, you are obviously seeing a different story, a different pattern emerging.
Yes, and you can see that pattern really clearly in some data from Zoopla that came out recently as well. Their data is showing a similar pattern to Nationwide, and they publish a map as part of their data, and it just really emphasises this north-south divide. Basically, everywhere south of the Midlands, prices are going down, and north of that, they're either flat or going up. The Zoopla data also talks about buyer demand and various measures of activity. That is all up. They say it's been a strong start to the year. Demand is higher than it was this time last year. But they've also got something pretty astonishing in here on the same theme about regional differences, Rob. They talk about how London has lagged the rest of the UK over the last 7 years. And of course, we know that's the case. We've been talking about it loads. But they also break it down between houses and flats. So houses in London have risen by 13% since 2016, compared to 34% for the rest of the UK, which is a big difference. But flats in London have increased by just 2% since 2016. Isn't that mad? It's just absolutely crazy. So flats in London have been an astonishingly bad investment over the last 7 years, pretty much the worst you could make. So at some point, they're going to become cheap, and that's going to change. I don't think that time is now, but it's an interesting one to watch.
It's fascinating, Rob. And when you say that, some people will be listening going, oh, God, I don't want a flat in London then. And I'm listening going, flats in London sounds interesting, because when something has been hit that hard, at some point it's going to recover. And you have to remember, it's not that it's grown a tiny bit since 2016. It hasn't. It's actually fallen dramatically in real terms, because when you take into account inflation and how much of that we've had since 2016, and the answer is a lot. I haven't got the exact number here for you now. And then you look at that tiny growth. Well, in real terms, flats in London have had a significant price cut. And at some point, and I agree with Rob, not quite yet, but at some point they're going to become attractive. I'm excited for when London becomes a good investment again. And I don't feel we're that far away. It's not a this year thing, but I do feel in the not too distant future, you'll be hearing us talk very bullish about London on the podcast. I just feel that once a market or an asset class is downtrodden as much as this one is, but the underlying fundamentals are strong, at some point it becomes an investment opportunity. But before we move on from house prices, we talked about how there's been this new year optimism, this new year bounce in sentiment, and that is absolutely reflected from numbers out from Rightmove in the last week as well. And they report on their asking prices. So not sold prices, but asking prices. But asking prices are a good reflection of how people are feeling about the market. And in January, they saw asking prices go up by 1.3%. And that is the strongest January increase since 2020. That is quite a strong statement to the year. We've had a few, rocky years, but that shows that at least New Year optimism is stronger than normal this time around. And that's interesting to see. That's what we're feeling and seeing in the market as well. And the data now is reflecting that as well.
And it's not just sellers. Agents and surveyors are feeling more positive as well. There's a monthly sentiment survey that's put out by RICS, the Royal Institute of Chartered Surveyors. This is relevant because if you fit the sentiment of their members against the nationwide data and correct for the lag, there's actually quite a good correlation. You can see that when surveyors start feeling negative, prices often follow downwards. But that sentiment measure is now at the highest it's been for 2 years. And it's not saying, prices are about to start flying up. They're talking about stabilising rather than going into some kind of boom. But all these data points we've talked about seem to be aligning, and that hasn't always been the case. It's not like people are losing their minds and going to sealed bids, but there's a lot more optimism than there was. But I don't think we can get complacent. Sentiment can shift really quickly. Things in the economy can change really quickly, especially at the moment. So I don't think we could stand here at the start of February and say that we're nailed on to have a positive year. Things might start going back the other way, or, as I perhaps foolishly predicted back at the start of the year, this could all snowball and we could have a really mega year for growth. All options are still on the table.
A quick note on rents before we move on to mortgages. And rents continue to move upwards, but at a slower pace than we've been used to. Data from Rightmove has shown that in Q4 last year, rents continued to increase outside of central London falling very, very slightly, definitely slowing down. So in the third quarter of last year, rents were up by 3.8%. That's the national average, excluding Greater London. But in Q4, it was up by just 0.2%. So significantly slowing down there, increasing, but slowing down dramatically. And Rightmove has commented on this set of data and said, well, due to affordability levels and improving supply and demand, they don't see rents pushing on as strongly this year, although they do see rents still going up. And that pretty much echoes what Rob and I have said in our predictions for this year as well. Will we all be right? We'll see. But if supply and demand does improve when it comes to rental stock, then rental prices will soften. London, though, really, again, interesting to watch because in Q4 it was down by 0.4%. And we'll see what Q1 data shows us when that eventually arrives. But I wouldn't be surprised if that continues to fall further. But while supply and demand is improving, it's still nowhere near normal levels. So inquiries for an average property at the moment are 11. That's triple what the numbers were in 2019. Although it is down from last year, which was 14. So while inquiries are still strong, we don't expect to see rental falls this year, but certainly not the double-digit rises that we've seen previously. That's the predictions. We will see in due course whether we're right or not.
We talked earlier about interest rates, the Bank of England base rate, and how that has remained unchanged. But the mortgage market is still responding to expectations that rates are going to be cut later in the year. And as has been the story of 2024 so far, we're seeing rate cuts all over the place. Recently, there have been cuts by Barclays, Virgin Money, TSB, Nationwide, and a whole load of others I could name as well. Looking at what's happening in the swap market, I can't see rates falling much further until the Bank of England does make an actual move downwards. But even with the mortgage market as it is now, there's data from the Bank of England showing that mortgage approvals have gone up again. That's the third month in a row that has happened. So, of course, everyone would like mortgage rates to be lower. Of course, there are still millions of people yet to refinance off the very low rates that they've got from previous years. And that will feed through over the next 18 months or so. But there's also ever more people looking at rates as they are today and deciding they can make them work, as shown by the mortgage approvals data. But as ever with mortgages, the market is moving really fast. Products aren't sticking around for long. So if you are taking out a new mortgage or you're trying to decide what to do, you've reverted onto a standard variable, you're trying to decide whether it's time to fix again, definitely work with a good broker and let them guide you.
So let's talk about everyone's favourite subject, politics and politicians. Well, first of all, an interesting piece from the IFS, that's the Institute for Fiscal Studies, and they say that the government should lay off landlords. I've always loved the IFS, Rob. What a great institution they are. They are not just saying it because they are big fans of property, although they might be, but actually because they feel like there's real damage being done. And they focus on stamp duty. They talk about all the taxes that landlords are subjected to, but they say one of the worst is stamp duty. And they actually comment that stamp duty in general is a really bad tax because it hurts the economy. Yes, it creates some income, but actually, if you opened up the property market and reduced or eliminated stamp duty, what you would have is a far more active market. And in the short term, it probably would cause a boom because everyone would get excited. But then after that, you'd have a much more fluid market. Many more transactions would take place. And if you have a lot of transactions, well, overall, that is good for the economy. So I can't prove it because I've not done a big report on it, but I would imagine, just based on common sense, and common sense has got me a long way in life, that if you removed that tax, the government, or at least the overall economy, would do a lot better. Anyway, I'll get off my soapbox and talk about this piece from the IFS, because they have said that the additional stamp duty that landlords have to pay, along with the other taxes that we have, are discouraging landlords to be active in the market. And they bring it all the way back to tenants. And as we've seen in the large increase in rental prices, when you don't have enough supply of rental stock, prices of rents will shoot up, and that is exactly what's taken place. And we've seen double-digit price rises with rents over the last 12 months. So not a great outcome for tenants. The way to address that is increase the supply. How do you increase the supply? Well, attract landlords to the market. And having this additional stamp duty tax is one of the things that stop landlords coming onto the market, the IFS says. So by removing it and just making it a level playing field with normal stamp duty, would mean that we'd see more supply entering the market and therefore a win for landlords, but also importantly, a win for tenants. Will it happen? I doubt it, because cutting taxes for landlords is like giving grants out to solicitors. It's not going to be popular, but at least there's sensible people out there pointing out the stupidity of some of the taxes that have been put in place over the last 5 or so years.
Well, after the next election, Rob, who knows? It's possible. Once you've got political capital, you've got some time, you don't have to worry about looking good for the electorate for a bit. You can do unpopular but sensible things. I'm not saying it's the most likely outcome, but it is possible. And it's good to see well-known institutions putting out stuff like this. Also in politics, something else that is still, of course, rumbling along is the Renters Reform Bill. This is going through its committee stage in Parliament, where MPs get to take a look at it, propose amendments, and so on. And unsurprisingly, MPs are not in agreement about some of the things in there and what needs to change. So if you, as a property owner, have never heard of the MP Anthony Mangnall, maybe you should add him to your Christmas card list, because he's put in some amendments suggesting that tenants shouldn't be able to give notice for the first 4 months of the tenancy. At the moment, as drafted, they could move in and immediately give notice on day 1 to move out again 2 months later. And he's also suggested that once the property portal comes in, which means landlords will need to upload all kinds of data about safety and so on, at that point, local licensing schemes, which are massively unpopular, should be removed because they do basically the same thing. So a really surprisingly sensible set of suggestions from him. They probably won't be taken, but you never know. And there are, of course, MPs going in completely the opposite direction. There's one proposal that, in effect, says that all grounds for eviction should be discretionary. So there should be no circumstance in which the landlord would be guaranteed getting possession of their property back. And the test for that is that if the courts believe that an eviction will cause greater hardship to the tenant than the landlord, then they shouldn't allow it to go ahead. But that's almost always going to be the case, right? Like, it's hard to imagine anything causing much more hardship than being kicked out of your home, regardless of the reason behind that. So if that particular amendment got adopted, that would be very, very unpopular and probably cause a fair bit of chaos. So this back and forth is continuing, and it's really important because this bill, once it becomes law, is going to govern everything about how we let property out for years and years to come. So we will be keeping you updated as it moves through the process.
And finally, would you like to see the 99% loan-to-value mortgage enter the market? Well, it's rumoured the government would. We mentioned this very briefly on the podcast last week, But stories have continued to circulate that this may be a thing, so we will keep you informed if this looks like it might happen. And of course, most importantly, what impact will it have on the property market if it does become a reality? I put a post on LinkedIn in the week to see what people thought of this, and over 70% did not like the idea. So not a popular one with the Property Podcast audience. If you want to give your vote and let us know what you think, then head over to LinkedIn, search for Rob Bent, you'll find me, and you can vote. And also have a little look out for Rob as well, because he's posting some really cool stuff too. So we're both on LinkedIn, so if you want to give us a follow there and see what we're up to, go check out what we're posting there. You get even more property goodness in your life. So it's time for Hub Extra now, the part of the show where we give you that bit more value before we let you go. And this week, Rob, you are single-handedly bringing the value. You've got a wonderful Hub Extra. In fact, this might be one of the best we've done in a long time. What a wonderful, wonderful resource that you are bringing our audience. They are so blessed.
You're a great co-host, Rob. Have I ever mentioned that? Yeah, so the Hub Extra this week is my book, The Price of Money, and not just plugging it again for no reason. The reason is that the paperback version comes out today, in fact. So the hardback and the audiobook have been out for about a year almost. Why paperbacks come out so much later, I have no idea. I still don't really understand the publishing industry, but it has finally come out today. So if you want to understand why we've had so much inflation, whether it's a problem that the government is in such a stupendous amount of debt, and what the future of money is likely to look like so you can position yourself to protect yourself from it, but the thought of lugging around a heavy book has prevented you from gaining that knowledge, then today is your lucky day. So if you are interested in checking that out, you can find it on Amazon or toddle down to your local bookstore and hopefully you'll find it there as well.
And if you have the hardback already, I've heard reports that you will be happier and smarter if you also own the paperback in addition. I can only tell you...
Pushing it now.
That's the room. I've got to be supportive, Rob. If you haven't read it, though, it's a great book. Please do give it a read. I think you were truly, truly missing out if you've not read The Price of Money yet. Rob's put together some brilliant books. Honestly, I'm not just saying this. I think this is the best of the lot, so do check it out. But if you're not going to buy the book, which you should, then we at least have to agree on one thing, and that is our handshake deal. I'm reaching out to you virtually and I'm putting my hand out and I'm looking at you in the eye because I want to shake. A few of you have given us the virtual shake over the last few weeks and we thank you for that. We look at the numbers and we see the difference and it's amazing. What is this? What am I talking about? Well, Rob and I, for over 10 years now, have put a podcast out every single week. Never missed a week. And we've had big life events in those 10 years, but we never let you down. Never. But we want something in return now. We're making an ask. We're finally asking you for something back. And that is to support the podcast and get the word out. So that's our handshake deal. If you've listened to, say, at least 5 of these podcasts now, then we need you to do something. And you can do one of 2 things, or if you're feeling very generous, both. 1, head over to our YouTube channel and subscribe and watch a few of the videos. They're really good value. If you're not a YouTube person, I'm sure you will be once you've watched the videos that Rob's put out recently. They're really, really good. But go and subscribe anyway, because that helps us. And second is share this podcast. Please, please, please do share the podcast. Podcasts grow through word of mouth. It's the only way, really, you can grow a podcast. And we've done wonderfully over the years. I can't complain with the size that we've got to. But there's so many people who are missing out who could really benefit from understanding these lessons that we put out, the news that we bring you, and the stuff on economics we do as well. I think if you understand economics, it can be life-changing. And hopefully you feel that way too. So if you do, let's shake hands and let's do it. Share the podcast. Go and find a few people today. Maybe put it on your socials or drop it in an email to a few people that you care about and say, hey, listen to this podcast. I think it'll really help you. And while you're there, go and click a button on YouTube. Make us really happy.
Yes, please do. And thank you to everyone who's done that already. We can see the difference it's making and we really appreciate it. And to show our appreciation, so much more coming up. We've got the Property Pulse newsletter hitting your inbox tomorrow morning. We're in the Sunday Times on Sunday. Ask Rob and Rob on Tuesday. All of that before we're back here with the Property Podcast next Thursday. So I hope we'll see you for at least some of that and have a great week. Bye-bye.
Bye-bye.